Well, hello everybody. Welcome, welcome. Hopefully you can hear me okay. Give me a thumbs up if you can. Today we're going to be talking about a lot, but mostly we're going to be talking about the market. It's a little bit of a catch-up live stream. Usually we go live Tuesdays and Thursdays at 9:30 a.m. Pacific Standard Time. You probably all already know that. That's where we analyze your deals and answer your questions. Did a lot of answer questioning yesterday with you folks in the Discord, so love chatting with y'all. But today, this live is going to be dedicated to your questions about the market, what's going on, and what I'm going to give you a quick outline right now as far as what we're going to cover, so you kind of know what to expect in this live stream here. Thank you for the thumbs up. So we're going to be talking about inflection points. I'd like to go through a little bit of a history of kind of what's been going on in the marketplace. We'll talk about 2006, 2008. We'll talk about FHA, Brexit, trade, home builders, GDP, Samsung and Tesla rates, the workforce, unemployment. Should you refinance? Should you buy? Is how we'll cap it off, and we'll also answer your questions. But let's get started. Let's start with the most important thing to me is sort of what what should we be looking for in the marketplace? And to me, we should always be looking for what I call inflection points. If you've seen my videos before, you know that those are exactly what I'm looking for in a marketplace. So anytime we have sort of a change in the direction of what's going on in the marketplace, that's, in my opinion, what we should be paying attention to. And so what we'll do is we'll go through a quick little brief history on what the last maybe 15 years have looked like, and then we'll try to learn from that to go forward. So and we'll try to make it less than that long. Don't worry, newbie. So let's just go through this history here briefly. I want to mention that a lot of people think 2008 is when home prices really fell, but we really started seeing home prices fall really in 2007, and as early as 2005 we started seeing the inflection points. So if we zoom in over here, we're going to go into November of 2005, and in November of 2005, that's actually where we started seeing the price increases halt. So, while from 2002, 2003, 2004, 2005, we saw prices go up, up, up. I'm going to get a different color here to give it a little bit darker. We saw that change. And all of a sudden, we had this change, and it's like, wait a minute. Wow, all of a sudden, the properties that were, that's not any better, is it? All of a sudden, the properties that were selling pretty quickly were not selling anymore. And guess which properties sell first in any market that you're in? We talk about this in the lectures. And I know there are a couple missing, by the way, in like lecture 84, 684, and like two of them in 7, like 13, 14, 15, I believe. We have those. Those are being published within the next 24 hours. Sorry about that. But anyway, so we saw this inflection point, and where did we see the inflection point? In sizzle hot neighborhoods. That is the neighborhoods where a property usually goes on the market and it sells right away because it's the most highly desired neighborhood. Those properties started sitting on the market. And that's all of a sudden where us agents, we start going, wait a minute, like what's happening here? That was me last summer. Last summer going, wait a minute, these are sizzle hot properties and they're all of a sudden not selling. So we saw that kind of flattening of prices start happening at the end of 2005. And that's when people really started realizing, oh, the market's actually starting to change. Then in 2006, it's like, wait a minute, like it's still inflecting down at a little bit of a faster pace. 2007, oh, it's inflecting down at a little bit of a faster pace. Oh, now it's just falling. Oh, now it's 2008. Beginning of 2008, what was really interesting about the beginning of 2008 is you actually, for the last 2 years, from November of 2005, maybe early 2006 to the beginning of 2008, you had the Federal Reserve and you had Congress trying to basically rein in the lending industry and the real estate industry from the fraud that was happening, the negative amortization loans, the liar loans, the dead people getting loans. But the problem is when the Fed works with Congress to get these things done and to sort of limit, a potential issues from the marketplace, it's not really popular, right? Because what does Congress want? Congress wants more home ownership in the United States. And, when the Fed or banks or regulators say, we need more regulation, well, why? Like, the party's going great. Why would we want more reg? So it wasn't actually until Feb of 2008 that the Fed really started going, no, 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 we're pushing through laws. Unfortunately, little too late. And that's when we really started seeing the free fall towards the end of 2008. So it's an interesting thing to keep in mind that the market gives you these inflection points pretty early on. I mean, we saw the multiple inflection points here in 2005, we saw it in 2006, we saw it in 2007, we saw it in early 2008. So to all of the people that suggest, oh, well, nobody saw it coming, nonsense. It was very, very clear what was coming, and the severity maybe wasn't very clear. So now let's fast forward a little bit. 2008, things sort of bottom out. 2009, we get some growth again in 2010. We get some adjustments in 2010, 2011. Really wasn't until 2012 that we started off this pitch of what we've seen the last 7 years here. And there were little bumps. There were bumps in 2000 at the end of 2013. There were some bumps as rates went up. At the in the middle of 2015, there were some bumps as rates fell. And so what happened here? Let's zoom in for a second to last year. If you haven't seen me explain this yet in other videos, or maybe you don't have a full comprehension, this is probably the most important part to understand as far as what happened last year. So at the end of last year, or I'm sorry, at the beginning of 2018, we started the year pretty hot. We actually started the year hotter than usual in most markets. And a lot of this inflection point here was basically due to stock market euphoria because of the TTP along with low rates. TTP being the Trump tax plan, which incentivized a lot of business spending. Why all of a sudden was our GDP upwards of 3.5 to 4% at the beginning of 2018? Because of the incentives to spend. And what this naturally does, and what really any kind of tax plan does, is you rob from the future to give it to the now. That is what tax cuts do. They rob from the future to give it to the now. And that is exactly what we got. So we got a stock market that skyrocketed. We got real estate prices that skyrocketed. Builders were freaking out. They couldn't keep up with demand. Everything was great. And so we saw then in the summer, all of a sudden, the Fed, whoa, wait a minute, you know what? Let's put a significant amount of more pressure on the market in the form of reducing our federal funds rate, or sorry, increasing the federal funds rate. That is effectively increasing mortgage and interest rates and borrowing costs. And so, what did we see in the summer? Well, all of a sudden, not only was sort of the Trump tax plan spending party over, but the Trump tax plan had a negative impact on the real estate market in that it doubled the standard deduction, which when we get to the tax section later, you'll see the standard deduction was a pretty big reason to buy a house in the United States, at least. And by doubling it, it made it less interesting for renters to buy houses, basically reducing demand. So now all of a sudden you have this downward pressure from the reality of the Trump tax plan hurting real estate. The SALT taxes, state and local deductions, were limited, again hurting real estate, and you got rates hurting real estate. So what happened? We saw prices fall that probably about 8 to 10% in most areas in the United States. A lot of this, by the way, we are still just now hearing. We're still just now hearing November data, December data, January data, Feb data. A lot of this is still sort of a trickle of a response from this. And that's why when I look at, well, what happened at the end of 2018? Well, so beginning of 2018, we have our run up, we have our fall. End of 2008, we're kind of like, what's happening? What's happening? Where everybody's sort of waiting for the Fed to like stop, like chill out, stop being so hawkish, so aggressive, right? Well, unfortunately, let's start with fortunately. Fortunately, the Fed pulled back and settled down in December, probably around December 16th, 18th. The Fed had a meeting and they really kind of U-turned on their position because they realized the impact that they had, especially after the stock market really took a dive in October, November 2018. Really, really rough time for stocks. And so December 16th, the Fed sort of pulled back a lot of their aggressive positions. And so what did we see? Quarter one, which this is kind of what I was expecting, was quarter one was going to be a big tell for our markets. And it was. In most areas, we actually saw significantly increased buyer demand. Why did we see increased buyer demand? Because around the summer of 2018, when all this stuff was going on, mortgage interest rates were about 5%. Well, by the end of 2018, when the Fed kind of took a little bit of a chill pill in the beginning of Q1, rates were closer to 4.3%. So actually a significant sort of climb back. And I should probably also say that they started out about 4.3%. So you can kind of see how rates went up and then kind of came down with the market here, right? So now this is the most interesting part about what's going on is now. And as usual, this is the most interesting time because it is the hardest to really talk about. I could talk to you all day long about what happened between this scale here, but that doesn't matter. We want to know about, okay, well, what's going to happen next, right? And obviously, it's impossible to predict that, but we could kind of gather some data and look at some things and try to assume, okay, well, what should we do? How do we protect ourselves by investing in real estate? Do we invest in real estate? Do we wait? What should we do? Okay, so now we've got we came out of the mess at the end of 2018. Quarter one came around, things popped up a little bit, rates fell over here to about 4.3%. Now we might even be at even a lower place. We fell probably another zero point 0.1 or zero point 0.2, so let's put us around 4.1 over here. So now here we are, we're at this question mark with rates lower than where they were at the end of 2018, sort of substantiating or continuing to push along this little upswing that we were seeing in Q1. And now we're deciding, well, what is the trajectory now? And so that's where what's interesting to me is I look at a lot of data. Anytime I can, I look at data. The big thing for me is look, I'm going to touch on, I'm going to refer over here to some articles here. What's interesting to me, or let me start with what's not interesting actually. See, things that are not interesting to me are things like a reduction in consumer confidence. And you see Samsung chip sales weakening, you see Tesla sales weakening, you see a lot of articles about growth fears. You see GDP estimates expected to decline. Well, why? Why would that happen? And why does that make sense? Well, it makes sense because we basically just had the flu and we were vomiting. And so, of course, people aren't that happy anymore because the end of last year was a rough roller coaster. It was one of those roller coasters where the person behind you is vomiting in your hair and you're not having a good time either, and they're not having a good time. So, my expectation is a lot of the data that we're going to see coming out within the next 3 to 6 months isn't going to be that good. We're going to see more declines in GDP estimates. In fact, the Atlanta Fed just came out revising down their GDP estimate to 1.3%, which is pretty dismal. It's about half of really what's expected for the year, of closer to 2.5%. But what does it mean for real estate pricing, and what do I think is going to happen? What do I think our actual direction is? And that's where there are other bits of articles. Let me see if I can conveniently find them, but it's not so important if I don't. The other one that here it is. Yeah, see, this is where my mindset heavily stands. This was a Wall Street Journal article. Growth fears hit stock surge. Whatever, blah blah blah. Okay, so here. So we talk about the moves underscored concerns about whether central banks' easy money policies will be enough to avert a deeper pullback. So basically, they're suggesting, look, we're seeing this volatility in German stock indices, we're seeing the volatility in the French indices, that is like the stock markets. We're seeing that in the United States. We've got Brexit, we've got China, we've got all these things going on. And so we see these sort of signs of slowing down, but wait a minute, a lot of the data that we're seeing in the United States, with the exception of things like consumer confidence and sales related things, much of, in my opinion, based on the spending craze of last year, is pretty strong. In fact, when we jump over to looking at, we look at debts, and we've referenced these charts before. I wish I could pull them up for us right now. But we look at consumer debt loads as a percentage of income are actually at the lowest point they've been in quite a while. We look at, sure, student loan defaults and car defaults, but they're also at no higher than significant levels that we've seen in the past. And we get a lot of commentary about basically what I call sort of newsline, drama, where we'll see videos that sort of compile together. Okay, here's all this bad news: Tesla sales plummeting, Starbucks is closing locations, or Toys R Us goes out of business. Whatever. A lot of these things, in my opinion, we have to really isolate as, okay, well, what are they? Why would Toys R Us close business? Is it because of the greater economy, or is it because Toys R Us and Sears, they just kind of sucked after the online revolution? So I so much try to isolate data, and I'm looking at things like, okay, well, what are jobs doing? And when I look at jobs, we actually see significantly more workforce participation than we have ever seen within the last probably 4 to 5 years, at least based on the articles and the research that I'm trying to pick apart data from. And I'm happy to link or send screenshots or pieces of all of these articles. But so I'm putting all of this together, and I always try to look and go, okay, what is this realistically going to be? And then we'll answer questions here in live too. What does this realistically mean for our economy going forward? We have news now that construction sales are down. That is, home builder starts are down. Also, not another surprise to me, because guess what home builders rely on? Home builders rely on prices appreciating. If prices are doing this nonsense and we're in an uncertain time, a builder is not necessarily going to take as many bets as they would. Look, when a market is doing this right here, builders don't have much to lose because they could just wait and sell it to somebody else. The market continues to go up. But when we're in uncertain times, where we kind of are right now, this little jiggle over here at the end, it's not such a nice market for home builders to be planning on these sort of 2 year down the road game plans. So I'm not going to prophesize on exactly what I think is going to happen, but what I will do is I'm going to give you some bottom lines as to what you should be doing, or at least thinking about, in terms of your real estate investments. So I will say, and this is not a prophecy, this is my personal opinion, based on what I'm seeing. As a personal opinion, I'm not expecting us to go into a crazy deflationary, runaway, terrible fiat currency explodes and the world collapses, uh, you know, bad disaster scenario. I'm expecting much more of uh, basically a continuation of some of the drama that we had at the end of last year, which, sure, we might see prices have bumped in Q1, but even if we see, which we've been seeing, median prices go up a little bit, I think 2019, probably at least for the next 3 months, is going to be pretty stable, relatively flat relative to last year. Last year being a significant roller coaster. So, based on this opinion, and really based on what has happened, the correction that we saw last year, that 8 to 12% shave off of values, what should you be doing right now? And those are the biggest things that I want to open up a dialogue on, because I've been getting a lot of messages about that from you folks wondering, well, what is it? How do we protect ourselves and what do I do? So, this the very first thing that I would do is I would say, look at your situation and ask yourself first the serious question: what is your income, and what is your actual potential for investing in real estate long term? So if you're looking at real estate investing right now and you're thinking to yourself, well, I want to get into wholesaling, or I want to get into flipping, or you know what, I want to buy something for 3 years, and then I'm going to move and sell it. These are going to be a little bit tougher environments now. Here's why. I have nothing against people wholesaling. I know a lot of people think that I do, but there's nothing against wholesaling ethically. There's an unethical version of wholesaling, but you know what? There's an unethical version of everything: doctors, cops, you name it, right? So I think wholesaling is going to have a little bit of a tougher time in a tumultuous economy, because wholesalers rely on flippers buying property, and flippers really insulate themselves by seeing values increasing. And I think we're going to see less and less flipping. And I would encourage less of you to consider flipping right now, unless you know you could score some sick deal somehow. Be very, very careful. So I would insulate yourself from really anything short term. A lot of folks ask me questions. Well, Kevin, I want to buy a house and then I want to sell it within 3 years. I would go into a deal like that with this mindset: fine, buy it, live there for 3 years, move, but instead of selling it, you should rent. I always suggest, instead of selling, consider renting seriously. I mean, you're all in the real estate investing course here. And so many people look at renting as, well, wait a minute, now I have to deal with tenants. Now I have to deal with toilets. Now I have to deal with a property manager. And I have to deal with, what if this happens? What if that happens? That is going to be part of the real estate equation. But all of this will also relate back to your income. This is why I wrote income here, number one. If you have an income that you think will be stable during any kind of ups and downs in the market, that's a pretty important thing right here. Let's actually write that down and say stable. If you have a stable income, or an income that you actually think will increase during any kind of ups and downs in the market cycle, then fine, you might be able to insulate yourself from risk in flipping or wholesaling or these kind of short-term bets. But if you have any kind of income that you think will stay stable, or you're not sure you're going to keep your job, or let's say you're in sales, you're in car sales, which I expect car sales to significantly slow down. They've already slowed down quite a bit. Or you're in real estate sales, it might become a little bit more tough. Anytime an economy goes up and down, really you start seeing newer agents oftentimes leave the business because it's harder to make money, and being more educated becomes even more important. So ask yourself, how stable is your income? Can you look at whatever deals you're looking at, and can you stay away from the short-term mindset of real estate? And after you look at your income, how stable your income is, you look away from the short term. You can still do these things if they turn out to be profitable. Just go into the deals with the insulative blanket that we all know and love. We call it the wedge. We've all heard it before. But folks, I don't care if you're buying right now. I just closed escrow on a house myself, with the exception of the fact that the house I bought was $650,000. And 2 weeks after I closed escrow, the same model in a worse location hit the market for $769,000 and sold right away. In such a scenario, it doesn't really matter if the market declines, because all of a sudden I know, well, my market value is over here. The market value could decline a significant amount and I'd still be insulated. But even if, and these are the things you should be thinking in your head, even if market values decline to say $500,000, I look at this property, I go, that's okay, because I know I have the stable income or the stable reserves to be able to make the payment. That's the most important thing. Now, if I looked at this deal and I said, okay, well, I have this $650,000 deal, it's worth $769, or you know what, who cares? Say it's a $650,000 deal. It doesn't even have to be this extreme. And say it's worth 700K. Ask yourself, are you suffering a significant negative cash flow by buying this deal to lock up the $50,000 in equity? We all want the $50,000 in equity for that long-term boost to our net worth, whether the property needs some work or whatever. This is all going to be math based. But is this a break-even property? Is it a positive cash flow, or is it a negative? And a lot of folks today realize, well, for a property not to be a negative cash flow, we generally have to put around 25 to 30% down. And I know that sounds like a bummer, but when we look at multifamily real estate, and maybe you've already seen the debt service coverage ratio lectures that we've had. When you look at multifamily real estate, how much do you have to put down to not have a negative cash flow? And how much do you have to put down for the bank to actually lend on the deal? Usually anywhere between 35 to 45%. So all of a sudden we look at commercial real estate here versus residential real estate, and we go, people will come to me and go, well, Kevin, I'm putting 10% down, but it's a negative cash flow. Yeah, well, no, duh, it's a negative cash flow, because even in commercial deals, you're putting 35 to 45% down to have a cash flow. So if you definitely want a cash flow, you put more money down, or you buy a less expensive property so that you can put more money down. Or the alternative is, let's say you don't have more money down, which is fine, but you know you're getting a wedge deal. You know you're into the game long term. You're not worried about flipping the deal. You're not worried about selling it in 3 years. Then it doesn't matter what the market value does. As long as right now you're locking in the 30-year fixed rate loan. This is really what all of us want in the United States. If you're not in the United States, don't worry about the 30-year fixed rate. Get a 10-year fixed rate loan, whatever. At least kick the can down the road 10 years, and then you'll go to an adjustable rate mortgage. But hopefully by the time you go to an adjustable, your income's gone up even more. But what's the worst case scenario? Worst case scenario, when you look at real estate, is you say, okay, well, all right, Kevin, whatever. I got my 600K deal or whatever. It's a 200K deal. Doesn't matter. It's a good wedge deal. There's money in it. But you know what, Kevin? Yeah, I'm only putting 20% down, or I'm only putting 10% down. And I've got, after I pay a property manager, I pay my taxes, insurance, maintenance, utilities, reserves, all of that, I'm going to be negative $200 to $300 per month. Well, all you should do is take whatever negative you think there is. Here's a new hack we haven't talked about before, right? Take whatever negative there is, double it in case there's any kind of softening in rents. So we're going to call this negative 400 to negative 600. This sounds pretty painful. This is going to make a lot of people feel painful. And I'm not advocating negative cash flows. Do not construe this as me advocating negative cash flows. I'm just saying, if you get a really good wedge deal and you can only put 10% down on it because you're going to live there, and when you go to rent it out, it would be a negative. Oh well, at least you capitalize on the wedge aspect, but try to stay away from negatives if you can. Now, you take the negative you think you're going to have, you're going to double the negative you think you're going to have, and now you're going to annualize it. And so what are you going to do? You're going to look at this and go, all right, well, this is going to cost me $4,800 to $7,200 to maintain this property, which keep in mind, this is like nothing compared to the 7% in selling fees you'd be paying, especially if it's a $600,000 property. It might be pretty similar if you're talking about a $100,000 property, but whatever. You guys could do the numbers and figure that out yourself in terms of the numbers, or you can bring your deals to deal analysis and we'll talk about them together. But now you look and say, okay, $4,800 to $7,200. If things not only go bad, that is, I end up with a negative cash flow of $200 to $300, but my negative cash flow doubles to negative $400 to negative $600, which is negative $4,800 to negative $7,200 per year. Now you have to ask yourself, do you have the extra $4,800 to $7,200 per year based on the income that you have? That's how you got to do the math. So, for example, if you are a couple and you each make $40,000 a year, that means you're making $80,000 gross. After you pay taxes, you're probably somewhere around, I don't know, maybe $64,000 of net income, right? Which is about, what is that? Somewhere around $8,000 a month. Now what you're going to do is you look at, well, what are all of my annual expenses to get by? Oh, look, all of our expenses to get by, still go out on dinners, pay for the place we're living, whatever, 50 grand. We got an extra 14K left. Great. Now, what are you going to do? Be more conservative when times are uncertain. Take that 14 grand and maybe don't yet buy a second piece of real estate. Maybe park this into, I hate to say it because I don't like doing it, but if you're uncertain, then something comes up. So many of us, they hear, oh my gosh, well, if I put 14 grand into a savings account, inflation's going to eat away at my savings. Who freaking cares? You need to have some money as reserves in real estate. I don't care if my reserves lose 1 or 2% a year. Big freaking deal. Inflation's going to be going down anyway here. We have so much of a productive labor force right now. We're not expecting to see any kind of inflation, which is one of the largest impacts into inflation. So put aside some money and be more conservative. And I think that is sort of a great way to touch on my buy advice right now. That is, analyze your income. How stable is your income? Where do you think you're going to be? Then can you wedge the deal? Put money aside and be more conservative, and save some reserve cash. And all of this, and then we're going to answer questions here in just a second. All of this goes into the same question. Should you refinance right now, or should you pull out a home equity line of credit? Well, we've got lectures up about home equity lines of credit and refinancing and which one I prefer. I'll just tell you right now, I much prefer the home equity line of credit right now, because the nice thing is if you establish a home equity line of credit, you're not paying any interest on it until you actually pull the money out and use it. So that's one of the reasons I like home equity lines of credit, although they can get frozen in the event market values fall. Although usually you kind of know if that's coming and you can pull the money out beforehand. On a refinance, you force yourself into a higher payment the day you close escrow on a refinance. So I'm not a big fan of refinancing, though it's a little bit more attractive now because rates have come down, to 2017 levels, we're calling it. So those are my thoughts kind of on refinance, HELOC. Would I buy right now? I would absolutely buy right now if I had a stable income. I found a wedge deal, which there are plenty of them out there. I see these deals all the time, and I know you can as well in your area, as long as you're not overly critical and you see the vision on the properties that you might be looking at. You're like, I don't see it. Or maybe you don't have that agent yet. I always suggest all of you get in touch with that agent and you get that agent to help advise you. Then you will find some deals. And then have money in savings. The whole, your money's going to get eaten up by inflation. It's just such a BS argument. Of course, we all know that, but it's not that big of a deal. So let's look what kind of questions we've got here. And I think that was a good sort of little market live stream we did there. And let's post your questions here in the live chat. And we'll go back to sort of regularly scheduled programming in our real estate agent, the sales course tomorrow, Wednesday, and then we'll be back here in the investing course Thursday morning at 9:30 for regularly scheduled sort of deal analysis and questions and answers. But right now, on the topic of the market, we've got Daniel here. The construction industry is still churning out jobs, and it seems like demand for engineers is stronger than ever. I've been contacted by 3 recruiters this year. Job market will stay strong. Yeah, I mean that's what we're seeing. One second here. There we go. That's exactly what we're seeing in so many industries right now. Is that still so many industries, even though consumer confidence might shrink, even though sales might shrink, that's okay. That's called a cycle. That's the business cycle. Sales increase, sales decrease. It's like in the Tesla article. The Tesla pushed a massive amount of vehicle sales at the end of 2018 because the federal tax credit was halving. So of course, they had a banner December in terms of sales and a pretty crappy January. Well, gee, no surprise because everybody bought in 2018 in December. That's actually a car dealer. I read that in an article as a car dealer term called payback for running a coupon, basically. So anyway, does a monthly Social Security check count as a steady income based on retirement? Yeah, I mean, I'd say so. At this point, there's to me no indication that if you're receiving, let's say you're getting $2,200 a month in Social Security, I have no expectations of that $2,200 a month disappearing anytime soon. It could be wrong. You never know what's going to happen in our political environment, but I don't think the rug's going to be pulled out from people on Social Security right now or collecting that kind of benefit. So if you have that and you're looking to invest that, especially into something like real estate, which what's so beautiful about real estate is a lot of people when they retire, they love investing in real estate because all of the rents they can receive, they can offset with taxes, insurance, maintenance, management, reserves, utilities reserves, and depreciation to where they're really showing like a net loss on their taxes for owning real estate. But really, it's a paper loss because of depreciation, and now they're still maintaining a lot of the retirement benefits that might otherwise go away if they had too much income. So, how would a lender view Social Security income? The same. Social Security income is viewed as an ordinary income by a lender, and they'll absolutely use that to qualify for you. I'm trying to decide whether I should get my bachelor's or put that money into a house as an investment. Well, Christian, I think it depends what you want to do. You want to get a bachelor's in art? I'd suggest get a house. Get a good wedge deal. And I mean, really, if you, whether or not you decide to go to school, I know it's probably predicated on money, but I mean, can you go to like a local community college for a couple years and kind of reduce the cost? What I see a lot of people do is they'll buy, let's say, a 3 bedroom, 2 bath condo near a community college. They'll rent out 2 of the rooms. They'll live in one of the rooms. Now their school costs are low, their housing costs are extremely low, and they're controlling real estate. So they're great little hacks to get into real estate, especially in a situation like that. So if you were supposed to live in the property because of the loan, is there any way for them to know I'm not actually living there? I get this question all the time. Look, it's obviously a legal question. I'm not an attorney. I can't give legal advice. If you want legal advice, you should consult an attorney, blah, 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 blah. So we know that part. I'm a real estate agent. As a real estate agent, I always encourage people do the right thing. Do what you're supposed to do. If you say you're going to live there for the year you're supposed to live there. And remember, you're signing a form that says you intend to occupy. So me as a real estate agent, I see that as well. I intended to occupy, and then oh shit, something happened, and this excuse, I just ended up renting it. But I'm still making the payment back. Look, I see people do that all of the time. Is the bank really going to go around knocking on doors to make sure you're living there, or drive by to see if your car's there? Probably not. And by probably not, I mean like 90 something percent probably not, because they just want you to be making your payment. Now, it is a technical default. We talk about that in the lectures. So technically, they would have the right to foreclose on you for not doing that. But, things for you to evaluate yourself. So based on the current market situation, does buy and hold rental a good option? Yeah, I mean, I personally believe so. I strongly believe that if you have a good deal with equity, I don't know that I would want to jump ship and pay the 7%. Here's why. Look, we already know that based on last year, we saw market values decline 8 to 12%. Why am I going to jump in, take another 7% loss, go down to a loss of 15 to 19%? Because what? I'm afraid the market's going to drop 20%? Maybe. Well, I just guaranteed it. You see what I'm saying? Like I just guaranteed that loss. That's one of the reasons I'm not such a big fan of selling because you are locking in guaranteed losses from 2018, and the selling costs are pretty expensive. Really, the only time you should actually be selling is if you have a better opportunity. Volume is low, absolutely. We're seeing a lot of low sales volume in different parts of the country. There's no doubt about that. That is absolutely coming out of the rocket, basically roller coaster of a year we had in 2018, followed by obviously the winter season. So we'll see how volume really picks up in March and April. Those are going to be tells in terms of volume. I'm doing a refinance because I had a super high 5.875 rate, tuning it down to a 4.65 and only adding 2 months to the original length of the loan. But HELOC coming very soon on one of my other properties. Good for you, Daniel. Daniel, that is an awesome opportunity to refinance. You're refinancing early in the loan. You're getting a rate reduction of over 1%. That is the perfect reason to refinance. Good for you. I love it. I have to get myself a Model 3. Yes, you do. Love those cars. I still see some developments that have been in progress for the past few months in an area I'm looking to buy. I imagine if they are building, they did the research and I can piggyback. Yeah, and that's exactly how I feel generally. Do know that most of the time when builders are building, what you see going up took about a year and a half to get to that point. They had to research the lots, they had to buy the lots, they had to, go through the permitting process, the planning process, the zone approval processes, whatever. And so you're really seeing an artifact of really probably 2016 decision making, which 2016 decision making may not have even anticipated a Donald Trump president. A lot of things to realize there. Congrats, absolutely. What do I think? Thank you very much. What do I think about recasting mortgage? Yeah, I saw your question somewhere else. So tell me a little bit more about this. Usually, when somebody recasts a mortgage, what they mean is, let's say they got a loan for 500K and then they paid off 200 grand of it. Well, now they're still making payments as if it's a $500,000 loan. The loan's just going to get paid off a lot sooner, maybe in 18 years instead of 30 years. And so recasting usually takes that now 18-year loan and bumps it back to a 30 by reducing your payment. I oftentimes think that's a great idea because anytime you can lock in debt for 30 years, I think it's awesome. I think it's very, very predictable and it's a lot safer. Anything that's predictable is safe. This is why I like fixed rate mortgages. Okay, what do I think? Okay, so we talked about that. Does my tax debt significantly affect my DTI ratio when considered by lenders considering backdating S corp for 2000? Okay, so obviously, CPA questions always ask a CPA, but let's try to give you some scenarios here, Chaz. So, does my tax debt significantly affect my DTI? Okay, so what I think you're saying is you want to go back into 2017 and maybe take some more deductions off your S corporation. So usually the way that works is you have an S corporation, I don't know, selling widgets, okay? So you go and you make $150,000 selling widgets, and after your S corporation writes off all of its expenses of say 50 grand, you take home 100 grand. So your distribution on the IRS 1040, your S corp distribution line says 100K. Well, now if you go back in and you say, well, wait a minute, I didn't have 50K in deductions, I actually had 75K in write-offs. Now your take home's only 75K, 75K over here. Absolutely, that's going to affect your debt to income ratio, if that's what you meant. Yes. So let's see. Thanks for being here. Thank you. Asked about the multifamily. Okay, hey, yes, okay. So we got a new member here that asked about multifamily versus single family right now. And I do recall, thank you. Also, is there a better place to source rather than LoopNet in regards to multifamily? Did speak to an agent about this, but he wasn't very helpful. Yeah, so what you're gonna find is, and you'll all realize this, you're gonna find that I hate to say it, but probably 8 out of 10 agents you talk to are not investors. That is, they are clueless about the stuff we talk about in this course. You will be miles ahead of a significant amount of agents out there. It just is what it is. It's just the nature of, unfortunately, sales. So the best ways to really get deals on commercial are to be pre-approved for a commercial loan and then really get into the offices of commercial brokers. So your CBREs or your investment companies in whatever area that you're investing in, and really get a network of people that realize, look, hey, here I am. I want to buy a $2 million deal. I got 200 grand ready to play. I got a partner that's going to come in with 400 grand. We are both ready to go. What do you need? You need like, what do you need from us so we can start getting some deals? That's probably the best thing to do in commercial. Commercial is a lot more, hey, I got a deal. You want the numbers? Send me the package kind of thing, rather than LoopNet, sort of the MLS of commercial real estate. LoopNet is going to be your bare minimum, but the commercial contacts are going to be a lot more important than LoopNet. But don't rule out LoopNet. You can still get good deals on LoopNet. Just in terms of multifamily commercial, 5 units plus versus maybe single family, the issue that I find in is really you got two different issues. In single family, and you should watch the three different kinds of wedges, the lectures we have on the three different kinds of wedges. You have in single family what I call the condition wedge, which is, everything's been updated, like the windows, the furnace, the plumbing, the electrical, but it's got nasty green shag carpet with mold and asbestos ceilings or whatever, like some nasty dump like that. But everything else, the expensive stuff has been spent on. You buy a condition wedge like that, great. You get in for 120 grand under market value, just like I just did. Whereas on the flip side, I also just had an offer of mine get denied on an 8 unit apartment building because I wrote the offer at what I thought was a very realistic price. But all the freaking sellers on multifamily seem to be loony in terms of their pricing, and they really are pushing for very, very high dollar values. And I would rather not overpay. So that's why I lean so heavily to single family, because I can guarantee an upside in net worth on single family, where on multifamily, I'm really relying on finding an owner that has not mispriced the property based on condition, but has mispriced the property based on rents. That is, the rents are too low. So hopefully that helps you out with that. So do not close the door to either option, though. I think both options are great. Congratulations, Pat. Uh, ba, 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 ba. Yep. You guys are talking about the Tesla. I hear from a realtor that effects are very local. So I'm in an area with a great company, basically. W income does not get affected very much. The market remains hot. Well, what area are you in? Sure. I mean, even if you're in an area where there are a lot of people with W-2 jobs or whatever, and it's like, well, our market is hot. That's great. But don't think you're not insulated from the entire market, because guess what happens in real estate? As let's say here we have California, here we have Florida, and here we have Texas. Well, guess what happens? If the market keeps booming in Texas and prices keep going up and prices go down in California, well, all of a sudden it becomes more desirable for investors to go, wait a minute, I could get some sick deals over here in California. The same is true if the market is booming in California and prices are falling in Florida. It's like, wait a minute, I could get some sick deals over here. So, there is an equilibrium throughout even probably the world economy when it comes to real estate. Anytime, look, people all the time, they're like, oh, well, California has such low cap rates. California's got cap rates of around 4% or whatever. Why don't I go over here to Atlanta and get myself an 11 cap? Well, I don't know. Maybe because the population's declining over there, or it's a crime-ridden neighborhood. Who knows? Whatever. And this is why I say there's a yin and yang to real estate, right? California might have 4% as a cap rate, but you might see appreciation of 6%. Maybe not this year, but in general, whatever. 4% cap rate, maybe 6% appreciation. Over here, you might see, this 11% cap rate, but maybe your appreciation is negative 1% because people are leaving in the area. See how it balances out? These both add up to 10%. I'm a very firm believer that the market, in this kind of sense, the number sense, tends to be relatively efficient. But in terms of the wedge sense, when things are misconditioned or mispriced, that's where the opportunities are. So, what else do we got? Once you bought a wedge deal, made the renovation, should I refinance to get rid of PMI and lower my rate? Yeah, if the numbers make sense, it's early in your deal, you should refinance to get rid of PMI, and you've done your renovations. Just have your realtor run the comps for you to see if it's realistic that you're going to appraise. Appraisers are very nervous about refinancing your deal, let's say within 6 months or whatever, unless it's like a slam dunk. So be careful. Don't be in too much of a rush. Otherwise, you'll burn $500 on your refi pretty fast. So is there a management service that only finds the tenants when the property goes empty? Yeah. So this is just, these do exist. They're the one-time rentals. Look up this website, Rincon Rincon Property Management. And I'll for those of you that aren't looking it up, I'll just explain it. But let's talk about that really quick. So they got a cool website here, and they have a tab of pricing. When you go to pricing, you'll actually see that they have self-management options. And so they'll say like, look, this is what we'll charge to market it, to show it, to take the applications, to do the lease, to do the photos, blah 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 blah. It's 4 grand and we'll do everything, or it's 2 grand, or it's 1 month's rent, whatever. There you go. You can pick and choose what you want. Oh, you want us to place the tenant, do the lease, do the walkthrough, do the photos, collect the rents, and do all that stuff for a period of 6 months or whatever. Great. That's going to cost you 7.9%. You want us to do all this other crap for you and remove all re-rental fees and stuff? Okay, that's 11.9%. Whatever. Like, it's all tiered. So of course, property management companies can do placement services for you. So, I'm wanting to, yeah, but look, if you're going to be managing the thing out of state, I mean, me personally, I'd rather just have the manager deal with the freaking place all the time. Like, yeah. North Carolina. Yeah, I mean, fine. That's great. I mean, it just depends on your area, right? And even within North Carolina, you got some beautiful beach areas that go up in value, and then you got other areas where it's kind of like, oh, it's in the middle of nowhere, and people are leaving this area. So, wanting to pull the trigger, wondering if the tax debt will screw me on the detail. Chaz, before you should make any adjustments to your tax return, you should just pick up the phone and call your lender and go, bro, here is my tax return from 2017. Here's the draft of what my tax return will look like for 2018. I'm wanting to make this change. Will I still be able to qualify? Here's all my stuff. Here you go. You figure it out. And guess what? They'll tell you. They will tell you, like, no, no, you're not going to be able to qualify anymore. Like, oh, no, no, you'll be fine. It's that easy. So, newbie, are you still here? I owed you an answer about the New York Times. Okay, wedge deals do exist, even in the Bay Area. Absolutely. What are my thoughts on rent restricted areas? Or okay, so those are two very, very different questions you got there. Rent restricted areas, could mean two things. It could mean that you can never rent the property, in which case, don't buy there. Which is probably part of what you mean with the affordable housing program. Affordable housing programs I hate because as interest rates go up, the amount of the cap that you could resell the property for goes down. So you leave oftentimes a lot of money on the table. You can't rent the properties out. I never recommend selling affordable housing properties, and I tell all of my clients not to buy affordable housing properties. Now, in terms of rent control properties, well, that's a different thing. Sometimes you just have to deal with rent control. So hopefully that answers that question. Let's see. Should I renovate or save my cash a bit for me to give me a blanket during this crazy market or renovate? Okay, good. So yeah, good for you, Tech. Um, should you renovate? Well, let me ask you, are you living in the property that you want to renovate? Because I think a lot of times we get carried away as human beings of, wanting to renovate our own properties. And it's like, well, wait a minute. Why am I spending this money? It's giving me zero ROI. It's better to wait most of the time. Maybe when you move, that's the time you renovate it. But if you're sitting there on your couch thinking, I want a new kitchen, because I know it's going to increase the value of the property because it's a crappy kitchen the way it is, I mean, but you're living there? I wouldn't do it right now. I would rather save the cash and wait. So, folks, Newbie had a question about what section. You guys should all read. I mean, look, you don't have to read the actual paper. I like reading the New York Times in the actual paper because for some reason they don't let me save stuff as PDFs from my phone, and it really bothers me. Whereas the Wall Street Journal does, and I can read the stuff on my phone. But front section's always great, but the business section is great because look who we got on the cover of the business section. Does anybody recognize this person? That's Morris Invests. Got a YouTube channel that sucks. It's got some splaining to do, apparently. Oh, well. Anyway, that's New York Times for you today. So, yeah, folks. Wow, 48 minutes of me just literally straight talking. I thank you all for being here. Oh, and when I say New York Times, I don't want you to think that I don't listen or watch Fox or CNN or whatever. I try to look at all sources, and I make my own biased opinions. I don't take theirs, okay? So, but I gotta get the data somewhere. And newspapers, whether it's the Wall Street Journal or New York Times or wherever you watch it or read it, at least you're trying to stay informed, and that is good for you. We are getting a duplex, and we'll be living on one side. Tips on rent collection. Is there any website you recommend? Well, I would probably honestly, if you're going to self-manage this thing, do not tell your tenants you are the landlord. Go on my channel and look at like meet Kevin landlord mistakes or property management mistakes, something like that. And you're going to see a picture of me and Lauren in the thumbnail. Watch that entire video. It's like 27 minutes, all of y'all on property management. It's like 27 minutes long. I don't care. Like literally watch the thing start to finish and you will get so much property management advice in one video that it's like, wow. The most important thing for you is do not tell the tenants that you are the owner. Instead, get a PO box and have them mail the check there, ideally early. Or what I like to do is here is whatever, a bank account with a doing whatever. Here's a bank account. Send it to the property management bank account or whatever, and just set it up for auto pay to this bank account number and routing number. Obviously, at that point, they need your name, so you have to figure out, is it in a trust? Are you going to open up an LLC for this bank account? Whatever. There are ways for you to sort of disguise who you are, but do not, especially if you're buying a duplex, the last thing you want is the tenant coming over to your door going, yo, stove's broken. Come fix it. Call the manager. You might be the manager, but they don't need to know that. Okay. You see what I'm saying? Oh, manager is not in. Guess you're going to have to wait. Whatever. Obviously, it's an emergency. That's different. So this will be my first purchase. Yep, totally. No, yeah. You have not picked up the phone yet to talk to a lender. So do that, okay? Let's see. Oh yeah, he is the Fox guy. He is the Fox guy. That's exactly right. He was on Fox and Friends. In fact, that's the first line. An ex-Fox News host turned real estate guru who pitched financial freedom is being sued by nearly 24 people. Ouch. How do I found out market trends? I got a video on this. Type into YouTube, meet Kevin, how to time the market. And I have like 8 steps for timing the market. It's me standing next to a dumpster as the thumbnail. And I tell you exactly how to do that. We talk about it in the lectures too somewhere, but anyway, still going through the course. No worries, folks. You guys can always ask your questions. Don't feel bad. Obviously we're still cranking out course lectures, so there's stuff that's in my mind that's not in lectures yet either, so it's fine. If I'm renting out my own house, should I act like the manager as well? Of course. You should always act like the manager. You're never the owner. You are the manager. Now, if they bluntly ask you, are you the owner? You don't have to lie. You could say, I'm a part owner, but I don't make the decisions. It's the other owner makes the decisions. Whoever's not there makes the decisions. Look, when Lauren and I get caught in this thing and I get asked, oh, are you the owner? I'm one of the owners, but I don't make the decisions. I'm just here to show the property. You want to talk to the other people, or I'll bring the message to the other owners. I don't have to tell them who the owner is. Meanwhile, it's just Lauren, and I'm going to come back and go, Lauren, what do you think about this? And then she handles it. Vice versa, Lauren's showing a property. They're like, are you one of the owners? I'm a part owner. I could pass the message along. She comes home to me and asks me, you see what I say? It's just, yeah. Who cares what difference does it make? They just want to be your friend. They want to give you flowers. They want to give you gifts. It's a bunch of crap. Yeah. Okay, great. So that's crazy. That was a good one, folks. Really enjoyed that. Thank you all for being here. Thank you all for watching this on the live or the replay. If you're watching this on the replay, really great, excellent information, honestly, for all of you to watch and catch up on. So thanks again for being here. And folks, we will see you on Thursday at 9:30 a.m. PST. In the meantime, feel free to post on Discord. You can also DM me on Instagram. You'll get me eventually on Instagram. You'll definitely get me on Discord. All right, thanks. Just don't DM me on Discord. It's weird. You're gonna message me on Discord. Post in like the general chats and the subcategories. You're gonna Instagram DM me. I'll get back to you eventually. All right, thanks everybody. Bye.